For decades, the global economy operated under a relatively predictable trade framework, largely shaped by the United States' commitment to free markets and multilateral agreements. But a new era is dawning, characterized by a fundamental shift in the U.S. trade agenda. This isn't just about tariffs, it's about reshaping supply chains, prioritizing domestic industries, and leveraging economic power as a tool of foreign policy. The question echoing across boardrooms and trading floors worldwide is, how are global markets responding to this seismic shift? The previous era was defined by globalization, the belief that open borders and interconnected supply chains led to mutual prosperity. U.S. policy promoted reduced tariffs, NAFTA, and the WTO. The goal was efficiency, cost reduction, and global integration. However, the current U.S. trade agenda marks a pivot. It's less about blanket free trade and more about strategic competition. This involves reshoring critical manufacturing, reducing reliance on geopolitical rivals, especially China, and protecting national security interests through economic means. Tariffs, once seen as barriers, are now tools. Export controls, once seen as exceptions, are now strategic levers. And industrial policy, once avoided, is actively promoted to foster domestic innovation in sectors like semiconductors and green energy. Several factors are driving this shift. First, national security concerns, particularly regarding technology and critical minerals. The U.S. aims to decouple from adversaries in sensitive areas. Second, economic resilience. COVID-19 exposed the fragility of highly optimized global supply chains, leading to calls for redundancy and local production. The focus is now on just in case rather than just in time. Third, domestic political pressures. The agenda resonates with voters seeking good-paying jobs and a revitalized manufacturing base. Economic nationalism is a powerful political force. Understanding these drivers is crucial as they dictate the longevity and intensity of the new U.S. trade policy. They are reshaping not just American industry, but the global economic order. No country has felt the impact of the new U.S. trade agenda more profoundly than China. Once the manufacturing hub for the world, China is now viewed by the U.S. as a strategic competitor, necessitating decoupling in key sectors. U.S. tariffs, export controls on advanced technology, especially semiconductors, and efforts to reshore production have forced China to respond. Beijing is accelerating its drive for technological self-sufficiency and strengthening its domestic market. Global markets react with volatility. Companies with significant exposure to both U.S. and Chinese markets face immense pressure to choose sides or build parallel supply chains, an expensive and inefficient undertaking. The long-term impact on global trade flows and investment patterns will be substantial. This isn't just a trade dispute, it's a fundamental reordering of economic allegiances. U.S. allies in Europe, Japan, and South Korea face a delicate balancing act. They share security concerns about China, but are deeply integrated into the Chinese economy. The new U.S. agenda often presents them with difficult choices. For example, U.S. industrial subsidies, like those for electric vehicles in the Inflation Reduction Act, aim to boost domestic manufacturing, but can be seen as protectionist by European allies, threatening their own green industries. However, many U.S. allies are also exploring friend-shoring, relocating supply chains to trusted countries. This aligns with U.S. goals of reducing reliance on adversaries and strengthening allied economic blocs. Global markets respond by reevaluating geopolitical risk in investment decisions. Supply chain diversification becomes a key metric, and companies look to leverage incentives offered by both the U.S. and its allies. Emerging markets present a mixed picture. Some stand to benefit from the U.S. push for diversified supply chains, becoming new hubs for manufacturing as companies move out of China. Vietnam, Mexico, and India are often cited as beneficiaries. However, other emerging markets that are heavily reliant on trade with China or have less stable political environments may find themselves marginalized or caught in the crossfire of great power competition. The shift places a premium on countries with strong rule of law, skilled labor, and existing trade relationships with the U.S. or its allies. Foreign direct investment, FDI, decisions are increasingly geopolitical. For global markets, this means a more fragmented and complex investment landscape. Investors must now assess not just economic fundamentals, but also geopolitical alignment and supply chain resilience when evaluating opportunities in emerging economies. Specific industries are experiencing monumental transformations. The semiconductor industry is at the forefront, with the U.S. investing heavily to bring chip manufacturing back home, leveraging legislation like the CHIPS Act. The question is no longer if change is happening, but how quickly the world will adapt to a new U.S. trade agenda that is reshaping who trades with whom, how goods are made, and where global power ultimately lies. We want to hear from you. How do you think this shift to friendshoring will impact the price of goods you buy every day? Let us know in the comments below. And if this deep dive into the global markets and the U.S. trade agenda helped you better understand the world economy, please hit the like button and share this video with someone who needs to see it. And if you want to stay ahead of the curve on global finance and geopolitics, make sure to subscribe and turn on notifications.